Coming up today, GDP comes in lower than expected, with higher than expected inflation, dash in hopes of a rate cut, giving us the possibility of stagflation. I'll show you what assets perform well in stagflation, along with a certain group of stocks. Alphabet surges on earnings, along with a pop in Microsoft, and oil ticks back up higher. Welcome back to the Click Capital channel, everybody. My name's Jared, and if you haven't already, hit that subscribe button as I do these daily market reviews every day after close. And a big thanks to all my regulars who hit that like button every day. You really do support this channel. And just to run you through the most important news, data, and events today. Before the market opened, we got GDP growth rate data. Expected to come in at 2.5%. Previous reading was 3.4%. Actually came in way lower at 1.6%, showing the US economy surprising on the downside, not growing nowhere near as fast as what we all had thought it had been, which did cause the stock market to gap down. However, it was a little bit of a buy the dip, and so that's the lowest reading we had in GDP, coming in at annualized 1.6% ever since GDP went back to positive in Q3 2022. The problem was, inside the GDP report, was an early look at the Personal Consumption Expenditures Price Index. That's the Fed's preferred gauge of inflation. That grew at an annualized rate of 3.4% in the first quarter, nearly double the 1.8% we saw in the fourth quarter last year. So that's suggesting the official print we'll get in core PCE tomorrow should come in a little hotter than expected. And part of that pullback in GDP is a pullback in consumer spending. Even though unemployment is at record lows, stock market's just off record highs, many consumers are not feeling like the economy is booming for them, and that recent uptick in the price of gas may have something to do with that. Spending for personal consumption grew by 2.5% during the first quarter, a slowdown of 3.3% in the fourth quarter. And so slowing economic growth with accelerating inflation, that's a scenario known as stagflation, where the economy is stagnating while there's still inflation. And in that scenario, the Fed doesn't really have permission to cut rates. And that's why we got the Treasury yields responding more to that inflation data today opposed to GDP, with the 2-year breaking above 5% for the first time since last year, and long-dated yields like the 10-year finding new multi-month highs as well, above 470, causing Treasury bond ETFs to fall again today. And we've even got some now talking about the risk of a Fed rate hike. After we initially started this year, the market hoping we're going to get 6 cuts, we'd have to have a real big surprise to get even half of that, looking at where we are now, coming up to half year. And so like a few of us have been saying for a while now, high inflation could be here to stay, especially as we've got commodity prices spiking. And that's why we've got the World Bank Group coming out and increasing their forecast for inflation on the back of commodity prices and geopolitics. And there could be more around the corner. Really important agricultural commodities, wheat, have jumped by over 12% just in the last week alone. But the real culprit, if you ask me, what really kicked off this wave of inflation was the Fed printing $5 trillion of new money electronically and then buying up assets, thus flooding the system with liquidity in response to the COVID pandemic, in which Jay Powell's already hinted that it may have been too much and that we won't really know until the future. And if you read between the lines, you could translate that as he definitely knows it was too much. Because can you just imagine if we didn't have the COVID pandemic and some of our favorite stores weren't shut down for a couple of months and the Fed just out of nowhere printed $5 trillion and flooded the markets? What would we expect was going to happen? Because regardless whether we're all locked at home for a few months, humans are always going to trade. We're still going to buy goods and services. We just had to do it online. And so the Fed has absolutely lifted the rug on inflation. They'll just never admit it. And even though they've been letting some treasuries and other securities mature and run off their balance sheet, it's still well above where it was pre-COVID, to the tune of $3.5 trillion. Same deal with the federal government. In addition to handing out a lot of stimulus, PPP loans, most of which went to a lot of people that didn't really need it at all, they too blew out their debt pre-COVID, $23.2 trillion to now well over $34 trillion. And so just remember, always, it's governments that cause inflation. It's not some profit gouging company. It's not some offshore dictator. It's not supply chain restrictions, any other buzzwords they like to throw around. It is 100% the government. And so even though the Fed does that quantitative easing under the guise of needing to stimulate the markets, markets have survived for hundreds of years without artificial Federal Reserve intervention. The net effect of it is it benefits asset owners, especially in countries like America. For non-asset owners, the so-called American dream is nothing but a mirage, as we can see in this chart here, of the wealth held by the top 1%, sharply accelerating ever since the Fed kicked off quantitative easing in 2008, whilst the wealth of the bottom half pretty much gone nowhere. And so you can just imagine what's going to happen in quantitative easing version 5. The next time when the economy inevitably has a hiccup, accident, recession, bear market, Jay Powell and his mates are going to come out, flood the markets again, and we're going to see this wealth inequality gap further widen, leading to more social unrest, populism, distrust of the system, whilst the elites and media try to bait us all into identity warfare when it's really class warfare that they're trying to hide from. So like JP Morgan CEO Jamie Dimon just recently said, if the US economy does go back into a 1970s style stagflation with low economic growth, high inflation, how do us as traders and investors hide out from that, if not profit? Well, last time we had stagflation was in the 1970s. And just looking at that decade on the S&P 500, stocks went nowhere. It's pretty much a kangaroo market, bouncing up and down. And in inflation terms, you would have actually lost money. So here's a look at the best asset classes for each year in the 1970s. Starting off with 1970 corporate bonds, doing the best. Tech stocks doing the worst. And if you look in the red, apart from 75, 76, when the market bounced back after the crash in 73, 74, stocks and tech stocks were some of the worst performing sectors. Like in 74, they're down 37%. Also negative in 77 and 79. Doing much better over that period of time was gold and commodities. However, there's another group of stocks you may not know did really well in that time as well, and that is of land banks. They're investment trusts that own large amounts of land. One of the popular ones being Texas Pacific Land. And so they own large amounts of land in Texas and then collect royalties on that from leasing it out to operators like oil and gas, utilities, farmers, and land can do really well in times of inflation. And that's why Texas Pacific Land Corp in the 1970s, going into 1980, went up 1,385%. That's 13x gain. Another REIT called PotlatchDeltic, which owns timberland, it too had a good 1970s, up 165%. Another one, Tejon Ranch, had a good 1970s, up over 100%. They're in the agricultural land business. And another one you've probably never heard of, Maui Land and Pineapple Company, too had a good 1970s. And the other ones I've got on my list here weren't around back in the 1970s. However, they could make for good hedges and diversification in times of stagflation. We've got Gladstone Land Corp. There's a look at the daily on Texas Pacific. Another one, Farmland Partners. There's PotlatchDeltic, Tejon, and Maui Land and Pineapple. Actually looking pretty good here on the daily. Got some big volume, momentum thrusts up. Looks to be in a good uptrend. So in addition to gold, commodities, land trusts are another good hedge on any potential stagflation, as typically growth stocks, especially tech stocks, will not do well if we go into years of high inflation, low economic growth, because they are very sensitive to interest rates. That's why we've got a billionaire investor who actually lived through the 1970s, was trading all the way through it. That's the billionaire bond king, Bill Gross, telling investors to avoid tech and stick to value stocks. And that was another area that outperformed most stocks in the 70s was value stocks. He went on to say Microsoft is the only buy if investors must dabble in the tech sector. He also questioned owning bonds with a 10-year above 4.7%, and he still owns some master limited partnerships. Companies that operate energy infrastructure still offering high yields, and he said the AI frenzy is showing signs of excessive exuberance. And so the stock market seems to be holding on a bit here, especially after we just got earnings from Alphabet and Microsoft. Along with the bounce in Tesla, VIX is still a little elevated, but some saying we may have already seen the worst of it this year with that 5.5% pullback in the S&P, and it's very well we get more market consolidation instead of a full-on correction as we get into the thick of Q1 earnings, with a lot of the most important companies beating on estimates. With research now out of JP Morgan saying the S&P is poised to gain 3% over the next 20 days as they just got a tactical buy signal, and that's based on their positioning monitor that flashes a buy signal when either short-term positioning falls significantly and swiftly, or when positioning is rising while the stock market is still below its recent peak. And that has a track record of being right 69% of the time. And it certainly wasn't looking that way last night after we got the response to Meta's earnings, even though they smoked it on numbers, only missing guidance by 1.3% or something. The market did sell them off hard, as apparently their huge spending on AI spooked investors. However, Meta's forward PE now is only in the low 20s, even though they're spending huge on research and development to AI, and what's inevitably going to give them a material lead in the future, as it's companies that can innovate and spend on R&D that end up winning. And like I said yesterday, I thought that dip was a good opportunity. I added a few shares myself today, and there was a strong buy the dip candle here on huge volume. We opened up at 421. We were trading down around 410, 414 late last night. We actually finished here at 441, trading up a little bit after hours in sympathy with Alphabet and Microsoft. And I wouldn't be surprised for it to fill this gap to the 50-day in the coming days, if not a couple of weeks. And doesn't the market always keep it interesting? Up big, down big. Got Alphabet up big. They just came in with the good earnings and music to the algo's ears first ever cash dividend, huge $70 billion stock buyback, and beating Wall Street estimates on results. Total revenue Q1, $80.5 billion, up 15% from a year ago. First quarter net income, huge $23.6 billion. What an absolute cash cow this business is. Translates to $1.89 a share compared with $1.17 a share a year ago. That's just amazing, the growth these massive businesses can still have, and just shows how dominant and global their businesses are with pricing power. Network effect allows them to easily create new products and straight away pull in big numbers. And like I've been saying for a while, Alphabet, Google, along with Meta, my two favorites out of mega cap tech, the best valuation, and now after hours, as we're up over 11%, trading at 174. That's well above previous all-time highs and is now head and shoulders the best performing mega cap tech stock out of them all. You look at Apple's well off highs. Microsoft is up after earnings as well, trading around 417, still off highs. NVDA still well off highs, as is Amazon, and we all know about Tesla, and it's Google. Absolutely smoking it here today, and it was only earlier this year and late last year. Everyone was worried about Alphabet getting eaten by Microsoft, OpenAI. A lot of people have given up on it. However, a lot of people forget they still dominate search, dominate video, a big player in cloud, Android, and now making strong inroads into AI as well. They won't be left behind in this trend. And as of now, it's just crossed over a 2 trillion market cap for the first time. And there's a look at their numbers again, easily beating. And this is good for the overall stock market as well, given some earnings momentum from the biggest players that really drive the indices these days. Microsoft also beat on top and bottom line. Earnings per share, $2.94 versus $2.82 expected. Revenue coming in billion better than expected. It too also growing revenue 17% year over year in the quarter. Again, just amazing growth for this, given the size of these businesses. And so what the market will really be looking towards now is core PCE price data coming out tomorrow, expected to grow year over year 2.6% and 0.3% month over month. Looking at the data we got today, that's probably going to come in tomorrow 0.4%, which the market may give a muted reaction because it's kind of already seen it. If it were to come in 0.5, we may sell off. Same with year over year as well. And consumer sentiment, that also may come in a bit below expectations. And on the back of that today, Fed Fund futures pushed back a second rate cut in December, now only expecting one rate cut in September. However, that's still a few months away. A lot can happen between now and then, and that is the last Fed meeting for the federal election, early November. Fear and greed index climbing towards the top of the fear zone at 40. We've had a bounce in breadth this week. However, we've still got more than half of all stocks below their medium-term 50-day average. The market still has a bit more technical work here to get in an uptrend. So the most likely path could be a period of consolidation. We've got good earnings now. However, we've got those high bond yields. Really going to help to keep a lid on the stock market. We may come up and test this 5100 level, and we may find support again at 4950. And I'd say that's what the VIX is suggesting as well. It's come off from its peak, but still well off its lows, kind of in a middle ground here, as is high yield bonds, and still a relatively firm dollar. Bitcoin consolidating, and crude just holding ground above the 50-day VWAP. Another nice move up for Chinese securities. Clean energy is still trying to find a bottom here, and the spread between value and growth stocks actually found a new multi-month high today, but we've still got high beta stocks versus low volatility consolidating, and the spread between discretionary and staples still a bit soft. There's a spread between copper and gold, which has been ping-ponging back and forth beautifully for months now, making it very easy for spread traders to trade this spread. No surprise, the spread of inflation expectations broke out. Gold miners the best performing sector today on a thick volume candle, and utilities still holding up there pretty well, given what competing bond yields are doing. Still got some volatility in the cannabis space, as we seem to be always waiting for the DEA to reschedule, certainly taking their time to do that. Continued push up in Tesla today, back above its 50-day, the first time in over a month. Trump media continuing a good bounce off its lows from a few weeks ago, and the banks continuing to have a little pullback here, bar JP Morgan still just consolidating there. Okay, so to sum up, we've still got a bit of a push higher in the immediate term, a lot more green up the front than red. However, we're still mostly red in the short term, sectors underneath their 20-day moving average. Got bond yields green across the screen, same with energy, staples and utilities, and inflation expectations. So still a bit of a defensive rotation, high yields, definitely going to help to keep a lid on growth stocks. But now we've got these really good earnings results. So we've got two big opposing forces here. Along with volatility in crude, I think we could be in for a bit of a period of consolidation for a little while, unless we get some real surprises, maybe even tomorrow on PCE. However, that should come in a little hotter than consensus, as we're all expecting now, and we'll see what the last day of the week brings us going into the weekend. Thanks very much for tuning in and supporting this channel by hitting that like button, and make sure you come back tomorrow and I'll break down everything for you again. Cheers.